Hi everyone, welcome back. I'm Kirill Tlai, investment analyst with a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. Today, I have one thing to discuss: AI demand. That helps unpack the recent scare in the market that we've seen. Let's face it, the sell-off in semiconductor names has been brutal. So let's discuss how big is the demand for AI and where is it going. I want to measure it 4 different ways: the order book, the consumption meter, the margins, and then the part I find most interesting, the ladder of what starts consuming compute next. And once all the numbers are on the table, I will show you one chart about the dot-com bubble that I think every AI bear should have to argue against. Let's dive in. Quick disclaimer: nothing on this channel is financial advice. I'm sharing my views and analysis, but you always do your own research.
This video was created in collaboration with the IT company Anderson.
Let me start with the cleanest demand number that exists in this market. And it came out of Google's earnings on Wednesday last week. Google reported a cloud backlog of $514 billion. Backlog, in their own filing language, means commitments in customer contracts that have not yet been recognized as revenue, and it explicitly excludes cancelable contracts. So this is signed, non-cancelable contractual demand. It is not pipeline, it is not intentions like some other companies do. It is not a sales manager's forecast. A year ago, that number was around 100 billion. Now it is 514, and it grew by more than 50 billion in the last quarter alone. For scale, Google Cloud currently collects about 100 billion a year in revenue. So the order book is worth 5 years of today's revenue. And notice the ratio inside the quarter. They delivered 25 billion of cloud revenue, and the book still grew by 50 on top of it. For every dollar Google managed to deliver, customers queued up 2 more. Microsoft and Amazon disclosed the same metric. Their latest numbers are from the March quarters, and both print fresh ones this week, right after I record this. As the books stand, the 3 companies together carry roughly $1.5 trillion of signed, contracted, non-cancelable AI-era demand. I struggle to think of any build-out in the history of technology that was this pre-sold. And this is the context for the thing the market punished Google for. They again raised this year's CapEx guidance to about $200 billion and repeated that next year will be meaningfully higher. But set the 2 numbers next to each other: 200 billion of spend this year against a 514 billion signed order book that grows by 50 billion a quarter and converts at more than half within 2 years. That is not speculative capacity looking for demand, that is capacity being built against contracts that are already signed. Whether you like the stock or not, the return math on that CapEx has an order book underneath it. Now, 2 honest caveats. First, non-cancelable refers to the commitment, not the timing. Google expects just over half of its backlog to convert to revenue within 24 months. And the conversion pace depends on data centers actually getting built and customers actually consuming. So committed money, uncommitted calendar. That's point 1. Second, and this is the serious one, a contract is only as good as the counterparty. Part of this order book is AI labs, Anthropic and OpenAI, committing money they have not fully raised yet. This is the part the market does not really like. If the AI lab fails to generate revenue, Google and the other hyperscalers will not be able to make money on all these data centers they're building. The question is about demand sustainability. And this is what the market is worried about. So instead of waving that worry away, let me spend the rest of the episode testing it. Is the consumption real? Is it profitable? And what is queued up behind it? Contracts are promises about the future. If the worry is that the order book is hollow, the first place it would show up is the meter. Commitment signed, but nothing running on them. So let's read the meter. What is actually being consumed right now? Google's model APIs are processing about 22 billion tokens per minute. A quarter earlier, that was 16 billion. That is 37% growth in 90 days. On the build commercial meter, the one that maps to revenue. On top of that, Google quotes a much bigger number, over 3 quadrillion tokens a month across all its products. But I want to be careful with that one. It includes all the 3 consumer surfaces. So I treat it as a scale illustration, not as a demand series. The build API line is the series that matters. There is also one fully public independent meter, OpenRouter, a routing marketplace where developers buy access to hundreds of models. Around the turn of the year, it processed about 5 trillion tokens a week. In June, 29 trillion, 6 times higher in about 7 months. Now, honestly about the sample, OpenRouter is a few percent of the global inference market at most, and it skews towards small, price-sensitive developers. I use it for the growth rate and the composition, never for the level. So, growth is enormous, and the composition tells you something important. Programming is now more than half of all tokens on the platform, up from about 10% at the start of last year. One more honesty point about the meter, and it works in favor of the demand story. Google's token counter only sees Google's own models, but plenty of customers run the raw computing power from Google and run other models on it themselves. Open source ones like Kimi, for example, or their own. Google gets paid, the backlog gets signed, the tokens burn all day, and the counter never sees any of it because there, Google is just the landlord, not the model provider. So the demand is even bigger. We just can't count all of it. Anyway, so I hope this answers the first half of the worry. The usage is real and it's compounding, but volume alone proves nothing. Volume sold at a loss would still be a bubble. So the second half of the worry is the margin. Can we actually know the margin on inference? The clouds do not disclose it directly, but there are 2 clean ways in. One from the biggest player in the market, one from the cheapest. The audited one first. Google Cloud's operating margin went from 20.7% a year ago to 35.6% this quarter, while revenue grew 82%. Operating income tripled to almost $9 billion in a single quarter. You cannot expand margins by 15 points during the fastest AI mix shift in your history if you are selling that AI at a loss. Part of that explanation, of course, is vertical integration. Google serves a large share of its AI on its own chips. So the margin a GPU vendor would normally take stays in the house. But the conclusion stands. At the infrastructure layer, AI demand is being sold at expanding software-like margins. And the cheapest player in the market told us the same thing from the other end. Over a year ago, DeepSeek, the Chinese lab that started the whole cheap intelligence panic, published its own inference economics. Their numbers. $87,000 a day of serving costs against $562,000 of theoretical revenue at least prices. That is roughly an 84% theoretical gross margin. Self-reported though. Think about what that means. The most aggressive price cutter in the industry, the one everyone assumed was dumping below cost, showed its work. And the work says inference carries software margins, even at the lowest prices in the market. If the cheapest seller has fat gross margins, everyone selling above them does too. And that is the piece that makes the price deflation sustainable. The cost of serving intelligence itself falls something like 10 times a year through better chips, better model architecture, better serving software. So prices can fall 10 times a year mostly by tracking the cost curve down. The fat margins cushion whatever the cost curve does not cover. And each price cut opens the next layer of demand. And the proof that this flywheel produces real businesses. Anthropic went from about $9 billion of run rate revenue in December to $47 billion by late May. And reports put its June quarter at about $11 billion of revenue with, for the first time, positive operating income, somewhere around $500 million. The fastest revenue ramp in history just crossed into operating profit. During the dot-com years, that combination did not exist. And notice what this does to the order book worry from part 1. The lab that has committed more than $100 billion to Amazon's cloud is no longer burning cash on every dollar it earns. So, today's demand is real and it's profitable. What remains is the forward question. Is this all the demand there is? So, where does demand go from here? The best way to see it is what I call the demand ladder. Every rung is a use case, and every rung that is already shipping bands 10 to 100 times more tokens per user than the one below it. The bottom rung is chat, the thing most people still equate with AI. One question, one answer, about 1,000 tokens. This is the rung the market learned to model, and it is the smallest one. One rung up, research. When a model reads 100 sources and writes you a report, that is on the order of 1 million tokens per task, 1,000 times the chat exchange. Then coding, the rung we are on right now. And the numbers here are measured, not guessed. A single agentic coding task runs around 24,000 tokens. A serious developer running coding agents all day burns tens of millions of tokens per person per day. That is 1,000 chat users worth of consumption in one sit. And remember the meter. Coding is already more than half of Open Router. This rung alone produced the demand we measured in parts 1 and 2. The next rungs are where the forecast lives. Consumer agents. The always-on personal assistant that reads your email, watches your calendar, books your travel, monitors whatever you tell it to. An agent like that plausibly burns tens of millions of tokens a day just operating. And I want to be straight with you. That number is my arithmetic, an order of magnitude estimate, because the category is too new for clean data. But the direction is not controversial. An agent that never stops consuming is 100 times a chat user. And the user base for it already exists. Google's Assistant app alone has nearly 1 billion monthly users. The intensity flip has not happened yet. When it does not show up in the meter as a trend, it shows up as a step change. Then video. A 2-hour generated film is on the order of 1 billion token equivalents, once you count the drafts and retakes. About 1 million chat conversations per movie. At current lease prices, generating 2 hours of frontier quality video costs thousands of dollars, which sounds expensive until you compare it with what 2 hours of produced film costs today. Video is the largest attention market on Earth, and it has barely started moving onto this infrastructure. And finally, the top rung, further out, machines that never stop inferring at all. A robot in operation is a continuous stream of vision and action that will need billions of token equivalents a day. Those two rungs are why I do not spend much time worrying about whether the current data centers will find demand. Here's the pattern of the whole ladder. Every time the industry found a new thing for models to do, consumption per user jumped roughly 100-fold. Chat to research, research to coding. Each step confirmed it. The next three rungs, agents, video, machines, are already shipping in preview. That is the demand forecast. Not a growth rate extrapolated on a chart, but a queue of use cases. Each 2 orders of magnitude hungrier. Each earlier in adoption than the one before. Now, with all the fundamentals on the table, the order book, the meter, the margins, the ladder, we can deal with the words that hang over all of it. .com bubble. Fiber also had demand forecasts. Telecoms also had capex, and it ended in a crater. Fair. So let's actually run the comparison instead of trading slogans. This chart takes the giant of each era and treats them as one business. Their combined market value and combined operating profit. The last panel, the .com years. Microsoft, Intel, and Cisco together. By the peak in March 2000, the market value of the three was up over 2,000% from 1995. Their combined operating profit was up 208%. The price ran 10 times ahead of the earnings, and when it broke, even the earnings broke. Intel's profit fell almost 80% in 2001. Cisco swung to an operating loss. The value round-tripped until it nearly touched the earnings line again. Right panel, the same construction for this cycle. Today's 10 largest NASDAQ companies from the start of 2021. Market value up 190%. Combined operating profit up 233%. Read those numbers again. In this cycle, the earnings line sits above the price line. In 2000, the price ran 10 times ahead of the profits. Today, the price is behind them. You can argue about many things in this market, but the claim that this is 2000 again dies on this chart. Quick look at the scoreboard before we wrap up. Same book as last week, no changes. The defensive side is starting to work. Healthcare, materials all gained more than 4% on the week. Financials were positive as well. That softens the temporary negative impact from structural assets in the basket. So again, it was a good call to move, to take profits in semis and move them in defensive sectors. Let me pull together. The demand under this build-out is contracted, $1.5 trillion sign. It is metered, consumption compounding every quarter. It is profitable at the cloud layer and now at the model layer too. The next 100-fold users, agents, video, machines are already queued. And it's not priced like 2000. The price is running behind the profits, not ahead of them. So my read stays what it has been since we exited semis at the start of July. Keep accumulating the quality AI names on weakness. That's it for today, guys. For the timely calls in between these videos, follow me on X. It is linked below. And that's it. If you got something out, hit subscribe and like, and I see you next week.